Good afternoon, everyone, and thank you for joining us here for another edition of our Financial Friday webinar series. My name, again, is Matt Fleming. I'm a Director, Private Wealth Manager here with Thimble Island Private Wealth. And we certainly appreciate you taking some time here out of your day to learn a little bit about personal finance. And today we're going to be doing a little bit of a conversation in the next 20 minutes or so on some of the basics of investing. Many people really find it a bit challenging to sort of get engaged in investing and planning and some of the strategy that comes along with that. There's a lot to learn and understand in this space. And as you can tell by our educational webinar series here, we think education and understanding and helping people understand a little bit more about the financial markets and how all of that sort of comes together for them personally is really the best way to help people get involved. So if you have, experience with investing, chances are that you sort of, think of yourself maybe in a couple of different categories. And so today, really what we're going to kind of focus on here is talking about, okay, are you ready to invest? What we would say is sort of talking the talk, and then 4 steps to becoming an investor. Hopefully throughout the course of the day today, learn a couple of new things, maybe some of the stuff you already know. But again, I think education is really the cornerstone of helping folks get involved and get engaged in learning and more and getting some of that money working for you in the markets, if you will. So the first thing that we're going to talk about here today is are you ready to invest? So, the first thing that we want to think about is okay, what category maybe that I fall in here, or what's my approach to investing? Do I, as we would call it, am I a do-it-yourselfer? So I prefer to kind of figure it out myself, do the research. There's a number of great sort of resources in terms of some of the new AI chat engines, as well as Google, et cetera, to be able to do some of the research on your own. Some folks that we work with prefer to do that, and they'll come to us and say, hey, here's the 3 or 4 things that I'm thinking about that I've been doing some research on. This is how I'd like to invest with inside the portfolio, and we can help, from that perspective. A lot of folks fall into, the second category here too, which is I just need a little bit of guidance and then I'm good. Meaning, hey, you know what, if you can do and point me in the right direction and give me sort of some parameters or some things to think about, I can still, do a little bit more of the research and be able to figure it out and feel pretty confident about that. And then the last category, which is certainly, a category that we help a lot of folks in as well, is please just take care of this for me. You know what? We trust your judgment. You guys do this all day, every day. And I don't really want to spend my waking moments that I have free doing the research for myself. So I'd prefer you just to sort of take care of it for me. What I'll say is there's no right way to do it. It's all about individual comfort and confidence that you have in terms of the approach that you're taking. And a lot of it has to do with, certainly if you fall into the second or third category there, again, the trust in the confidence in the person that you're working with to give you that advice and guidance and sort of taking care of it for you. So, again, the most important thing that you can do though is regardless of which category you fall in, is putting that sort of informal investment strategy in place and then working towards it as you're doing that. It can be very, very empowering once you know what those sort of financial goals are and your investment strategy that you're sort of putting into place there to help you achieve those goals. So are you ready to invest? So it may seem a little bit intimidating when you think about investing and getting started in some of the process. But what we advise folks, especially on a lot of the corporate retirement plans that we kind of help with, is the sooner you start, the easier it becomes, kind of building that nest egg for your future. So, it always includes a little bit of a risk when you're investing, especially into some of the markets, stock markets, et cetera. So it's important that you have that sort of solid foundation before you really kind of jump in and start thinking about investing. So some of the things that you want to make sure that you're covered, you have covered before you start to invest, is you have a steady income. So you have money left over after meeting those monthly financial obligations that you have. So again, if you have that sort of budget and you've got some money left over at the end of each month, that's a good sort of starting place to say, okay, what can I maybe start to think about from an investment strategy with some of those leftover funds? You've considered the effect of upcoming personal changes. So are you getting married, having children, additional children? Divorce that we have listed here. Those are all sort of significant that we'll call personal financial changes that you want to sort of consider before you start, investing into the markets, if you will. And then once you've built up your savings, so what we really look to is an emergency fund that covers basically 3 to 6 months of basic expenses before you start to think about that investment account. And so what I'll kind of caveat this with as well is this is really when we're thinking about this is sort of that investments maybe outside of that retirement plan that you're doing as sort of payroll deferral, et cetera. We're talking a little bit more about kind of some of those after tax dollars out of your paycheck each month. So do you have that sort of emergency fund set up? And if you do, the 3 to 6 months, okay, now's a really good time now to start thinking about, okay, how do we diversify and maybe add some longer term growth strategies kind of going forward. So there's a bunch to consider there, but certainly those are great things to think about before we start to invest, if you will. So talking the talk. So this is where again we the cornerstone of these sort of educational series is this knowledge is investing power. So the more that you know and understand and educate yourself, the more empowered you're going to feel when you're looking at the overall markets, investment strategies, et cetera. One of the things that I do on a daily basis is the Wall Street Journal. And so the Wall Street Journal, you can do it in an app form now, rather than getting the thick newspaper every morning. I still know a few folks that prefer that way, but they've made it really easy to be able to get the information now on your phone, on your iPad, or right online. They do a great job as well as giving you a little bit of like a morning digest. So they'll give you sort of 10 points of things that are going on in the overall markets, sort of highlights, if you will, with the actual articles attached to the, hyperlink to those different 10 points there as well. We also publish a weekly insights report, LPL Research does. If you joined us last month for our sort of mid-year check-in with one of the gentlemen from the LPL research teams, this is that group. They publish a weekly report that you can sign up to receive that will also give you a little bit more of an insight in terms of what's going on in the overall markets and some things to be thinking about and trend lines that might be happening, et cetera. So, a great way to sort of start with building that base is kind of getting involved and reading some of those different publications that are out there. So, kind of to jumpstart a little bit of your knowledge here, and this may be a little bit of a review for some of you, but first you need to be familiar with some of the major benchmarks. So if you watch CNBC or the news, et cetera, they're very often talking about some of the major benchmarks and giving you a daily update in terms of what's going on. The first one that we're going to talk about is the Dow Jones Industrial Average. So this is the oldest and best known of the American stock market indices. It actually began back in 1896. And it consists of 30 blue chip stocks. So these stocks are selected by the editors of the Wall Street Journal. And the Dow Jones Industrial Average, Wall Street Journal, for those that may not be familiar, the parent company there is Dow Jones and Company. So not a coincidence there that the Wall Street Journal is involved with kind of selecting some of those stocks for the index. But the companies that are in the index are actually pretty diverse and represent all the major business sectors. So you'd recognize, if not all the companies, but most of the, some of the bigger ones that you would know and are included are Johnson and Johnson, as an example, Coca-Cola, McDonald's. And the criteria for a company to actually be involved in the Dow is that companies are leaders in their industry, and it's very large. So it takes a very significant change in those companies for it to be considered to be removed from the index. And therefore, this is, again, an important and consistent benchmark in evaluating just how the stock market in general is performing. So that's the one that usually leads the nightly news, if you will, is what happened in the Dow Jones Industrial Average. The other sort of large one that you'll hear referenced most frequently as well is the S&P 500. So Standard & Poor's 500, that's the 505, believe it or not, largest companies that exist, and that is another very well-known index that's quoted pretty frequently on the evening news, if you will. And the last one here, which is a little bit less familiar potentially, but you will see it sort of, again, if we're going sort of off the evening news track there, but you'll see it sort of quoted, is the NASDAQ exchange. So this is the index option, excuse me, that was the NASDAQ's actually an exchange. It stands for the National Association Securities Dealers Automated Quotation System. So a mouthful there. But that is where the NASDAQ acronym comes from there. So they were the first exchange to actually offer online trading. And the index is made up of a lot of mainly tech-focused companies. So you'll see Apple, Facebook, Google, Amazon. Those are some of the larger companies that make up the NASDAQ exchange. But they also include smaller companies. So Angie's List is an example here, 1-800-Flowers, Starbucks. But again, they generally have a little bit more of a tech focus. But some banking companies, airline companies, and again, like we mentioned, Starbucks, or even like Steve Madden as an example. Those are all businesses that are included in the NASDAQ as well. So again, couple of popular types of exchanges to think about, and hopefully a little bit of information there that maybe you didn't know about some of those that we see quite frequently quoted. So the 4 steps to becoming an investor, and what we'll talk a little bit here about is kind of each step individually. But the first thing here, and this is one of the #1 things that we as financial planners do here at Thimble Island Private Wealth, is learn which investments are appropriate for you and your financial goals. Everything that we do from an investment perspective, we try and relate back to the financial plan. So what are some of the shorter term, longer term, intermediate term goals that you have? And then what type of investments can we match with those different sort of financial goals? The first thing that we'll cover here are stocks. Or stock mutual funds, as an example. So these also can be known as shares of a company or equity in a company. And it's a type of security that gives you proportional ownership in the issuing company. So as a stockholder, you're entitled to a proportion of that corporation's assets or earnings. And so again, you've got that sort of fractional ownership in the individual company that you own the stock, or part of the share of equity in the company, if you will. They're bought and sold primarily on stock exchanges, and it's with inside a portfolio, it's really the foundation of a lot of portfolios that we construct. But really, when you look at like investment strategies, they tend to be the primary kind of foundation with inside those portfolios. So they have high risk, but also high return potential. Based upon, when you're looking at the average investor, these are really typically considered as part of like a longer term investment goal. So you see them inside of 401ks or individual retirement accounts. And we do see them in sort of those non-retirement accounts as well. But more so, we see them being utilized where you've got more time on your side. You can be a little bit more aggressive, maybe don't need the money in the short term that we're purchasing with the stock with, and you're taking on a little bit more risk. So again, this is, when we talk about, the overall investing, this is the number one thing that people think to is stocks. Another area of a portfolio and investing is what we call bonds or bond mutual funds. So bonds are used by companies, municipalities, governments, et cetera, to finance projects and operations. It's essentially a form of debt. So owners, if you are buying a bond from a company, so Amazon, Google, et cetera, a municipality. So if you live in the state of Connecticut, we're here in Branford. Branford issues what's called municipal bonds, or different various sovereign governments. So the United States issues treasury bonds, et cetera. What you're actually doing is you're taking your dollars and you're loaning it to that company. And in return, what that company, government, municipality, et cetera, is doing is basically giving you, at the end of a finite period, a maturity date is what they call it. They're going to give you the principal back that you invested plus a stated interest rate that's paid sometimes along the way or at maturity. And basically that's, bonds can be traded much in the same way that stocks can be traded. And you can see the increase in value of bonds. If, as an example, if interest rates go down and you have a bond that's paying you, a 4 or 5% interest rate, but new bonds are only paying 3, the value of that bond that you hold actually is worth more to somebody if they want to buy it from you. What a lot of people do is sort of hold them to that maturity. And again, you get your principal back and you get to keep all the interest that was paid along the way. These are great because they're sort of moderate risk. So there is some risk. Again, it's not risk free because the risk there is you're loaning money to a company, municipality, or government. So you want to make sure you check the credit rating of those various issuers of those bonds, et cetera. And the higher credit risk that the company or municipality or government has, generally the higher return that you get, because there's a little bit more risk there. That because with bonds, the risk is those companies go out of business or go belly up, need a bailout, et cetera, and they're not able to make good on those obligations. But with that sort of moderate risk, you get a little bit more moderate return potentials because, again, you're collecting interest along the way, and sometimes you can see a little bit of appreciation in the value as well. A lot of times where we see bonds fitting in with sort of the portfolios, those are sort of like midterm financial goals. So college funding sometimes is where you can take on some risk, but you don't want to take on a lot. And there's a sort of finite period. You can look for maturity dates that sort of match up with some of the goals that you have and when you need that money due. And then we also see these being used a lot with inside of retirement portfolios. And what we term here on the slide, the later years, but we think of that as being, those years where we start to take distributions from those retirement portfolios. And again, the main reason there is they offer a way to collect interest along the way, and a little bit more stable than securities, if you will, kind of moving forward there. So overall, again, generally we see this make up in many instances, depending on risk tolerance, need, et cetera, 30 to 40% or more in some cases of portfolios. And then the last one that we'll mention here is sort of what we call cash or cash alternatives. So these are typically money market type of funds. These are lower risk, consistent type of returns, but lower overall. And when we think of these can be, shorter term financial goals. So this is a great way. Okay, I want to save for down payment for a house, or I need, in 10 years, I have a chunk of money that I'm going to need for a renovation on my home, or I want to put a pool in. We've helped clients with that. That might be a bigger part of the portfolio depending on what those goals are. And these sort of cash alternative money market funds are a great way to earn a little bit more than just sticking it in a bank account, if you will. But they don't generally have much more risk than, like a bank account, if you will. We do also see these later in portfolio years of retirement portfolios, just again, offering a little bit more stability and income for folks that may need that in retirement. So those are kind of the three major categories when we think about general investing. And when we look at, okay, well, what does it make? What should I be expecting? And how should I be thinking about my portfolio? This is a little bit of a historical snapshot, again, only through 2022 here, but the trend line remains very much consistent. When we look at the overall types of returns that we're seeing from those sort of some of these different asset classes. So stocks, the average annual return is upwards of 8 to 9% historically. Over the last, call it 30 to 40 years. Government bonds. So again, think about these as like United States Treasuries, et cetera. Historically, that's about in the 3% range. Treasury bills. So again, those are very short government sort of bonds, if you will, but very short duration. Those have a much, much lower historical rate of return at like 0.4%. And then when we look at what we're really trying to think about longer term is well, even if I'm only earning a little bit, am I losing some of that purchasing power due to this last note here on the slide, inflation? So over this same time frame, inflation's looking at almost 2.7475% historically is the average. So if we're investing only in T-bills, we're kind of losing some of our money year over year just in terms of the purchasing power. So when we think about that, it leads us to sort of the next part of when you're thinking about your portfolio, you want to embrace diversification. So thinking back to that last slide, we saw stocks historically is around 8%, government bonds is around 3%, T-bills, very short liquid type of assets is under 1%, and inflation's at 2, we'll call it 2.5 to 3%. Adding diversification to your portfolio gives you the opportunity to have different buckets of money doing different things for you, and really allows you to have, we put it on the slide here, is don't put all your eggs in one basket, but it gives you the ability to basically spread it around a little bit depending on some of the goals that you have, and again, allow you to seek better types of returns longer periods of time by having that diversification. And overall, when we think about that, we certainly want to be outpacing inflation. Even if we're in retirement, the number one thing that we look at and plan for is that inflation factor, combined with what we're taking out in terms of distributions, and how do we overcome that with the portfolio balance, if you will. So if you've got a large group of investments within inside there, you have a chance to benefit in different areas, even if certain parts of that portfolio aren't doing well for a shorter period of time. It shouldn't really give you too much of a downturn if we see another area might be performing a little bit better when stocks are down, vice versa. If stocks are up, maybe the cash component's not keeping pace just as much. So it's a great opportunity to add some of that diversification to our portfolios. And the last thing here that we talk about is a lesson from Lifesavers Candy. So, Lifesavers was invented by a gentleman named Clarence Crane in 1912. And at the time when he invented it, he manufactured one flavor of Lifesavers, and it was peppermint. A year later, he was actually approached, Mr. Crane was approached by a gentleman, Edward Noble, and he suggested that maybe offering some different flavors of lifesavers would be more attractive to more customers. And so, Mr. Crane wasn't really interested in that concept at all, but was agreed to basically selling the entire Lifesavers business to Mr. Noble for about $2,900, which in 1913 was probably a ton of money. But throughout the lifetime, Mr. Noble went on to develop $1 billion business by manufacturing different flavors of Lifesavers. And basically the sum of the story here is by diversifying his product, he made it more appealing to more people, and he protected his business from the risk of one day a large swath of people waking up and saying, oh, peppermint's not the flavor. And it enabled that business to sort of grow and flourish. And that's really what the premise of this story is that can help with your investments too. So if you spread the risk across different asset classes, different investments, you can help protect sort of the potential longer term returns that you have inside of the portfolio there. And then, step 3 here, we want to help you understand how the economy affects your portfolio. So the state of the economy, is a lot of news, that you hear a lot of times, but how a country is using money and resources to produce goods and services can really affect the stock market and in the activity in the stock market. When we talk about the economy growing, shrinking, or standing still, a lot of times it still overall affects the influence of stock performance. So one of the bigger things that we talk about when we talk about the economy is and you may have heard this, bulls versus bears. So a bull market is an investor or a bull investor is investor with confidence high and that the stock market's going to increase. And most stock holdings are going to kind of continue to increase in value. With a bear investor or bear markets, investors are nervous. We tend to see stock prices decrease, and many stocks are undervalued in those types of markets. Bear markets can also be a good opportunity to buy in for a stake of a good company at a discount in the stock price if it's appropriate for your situation. So again, bulls versus bears, that's kind of one of the common trends and themes that we hear when we think about the stock market. And then inflation is another one. So when we think about inflation, prices are rising and purchasing power is falling. And so basically, if you think about it this way, $1 today, if inflation is increasing, isn't going to buy as much as tomorrow as it can today. And historically, the cost of goods, services, et cetera, has always gone up. But when we think about inflation, low inflation can be potentially good for the market. Low inflation means that, people are able to sort of keep pace with it. Maybe wages are keeping pace with it. And it's giving you an opportunity to have some additional cash, et cetera. Things aren't costing as much. So that can actually generally cause the stock market to go up sometimes because people are investing, into the market, and corporations actually are making a little bit more money in those instances sometimes because folks are buying more goods and services. High inflation can be the opposite, obviously, potentially bad, because when inflation spikes too high, people can't afford to buy as much as they could before. And then you start to see sales slump with some companies, potentially causing stock prices to drop. So again, just a kind of a basic overview when we think about inflation and how it affects, excuse me, the overall market. And it can also, when you think about it, inflation rates as well, excuse me, they're influenced by the Federal Reserve Board. So the Fed, you quite often hear on the news when we're coming up on Fed meetings, but they're the government entity that takes responsibility for implementing interest rate strategies to sort of support the economy. So, when we start to think about, okay, if inflation is running too hot, Is there a way that they can kind of help with that with interest rates? Maybe increasing rates, making it not as easy to, borrow money, et cetera. And so when we see that, generally speaking, interest rates can include anything there, credit cards, mortgages, car loans, saving rates that you receive at your bank account. When we see rates increase, we generally tend to see stock prices drop. Has an inverse relationship there, but as money becomes a little bit harder to borrow or a little bit more costly to borrow, it usually slows down the economy a little bit there, and we see stock prices generally come down a little bit. When rates go down, so when the Fed cuts rates, as you'd imagine, stock prices go up. Again, having that inverse relationship, money becomes a little bit more freer, a little bit less costly to borrow when you're spending, et cetera, mortgages, car loans, again, credit card interest rates even. Sometimes then that allows for more money to be invested into the market, which can positively impact stock prices, et cetera, as people are buying in. So the last step here that we'll talk a little bit about is seek professional help if you need it. And this is again some of the basics. What we're trying to share with you today is just some basic help to get you started and what you should think about when investing. But overall, what you need to know is that there are professionals that are available to help if and when you need it. And that's, here at Thimble Island Private Wealth, that's one of the bigger things that we do is we give you that sort of personal hands-on guidance and advice to help you determine first, again, those financial goals that you have, and then how we can help you achieve those through the investment strategy that we can help you put together. And again, some of the things that we do with clients is help you understand the different types of investments that are available to you out there in the marketplace, and the way that they can be intertwined in sort of a balanced investment portfolio. The number one thing that we help folks with is that goal strategy setting, retirement goals, buying a home in the future, funding college education for kids, grandkids, et cetera, starting your own business, or again, just getting better at budgeting and paying down debt. I'll kind of cross credit card out of there and just say all debt. That can be student loan debt, credit card debt. If you have mortgage and you want to pay that off more aggressively, we can really help you understand how that works within your budget as well. We can help you figure out that sort of investment strategy based on those goals and the time frame that you have and the risk tolerance that you have. We recognize that not everybody is going to fit into a growth portfolio or a moderate portfolio or a conservative portfolio. We want to work with you and say, okay, do we have different buckets that are available that we want to segment for those different goals? And then help you say, okay, where do we want to take risk inside the portfolio, and where don't we want to take risk, and how much risk are we comfortable with? And those are all conversations that we have with our clients as we're helping to try and develop these strategies. And we're also going to bring you different professionally managed investment strategies that might be of interest that maybe you're not thinking about. And then lastly, this is the big one, is meet with you on that sort of regular basis to track progress that you're having and adjust goals, strategies, et cetera, when necessary. We take a very hands-on approach to be able to do that. And that ranges from making sure that, hey, nothing's material changed in your day-to-day life. And then there's no new goals, no new things that you're thinking about. And then making sure that the investments within inside the portfolio continue to align and meet those expectations of what we anticipate, for the portfolio to be able to return there. So again, we're happy to sit down if we're not currently working with you as investment professional, financial professionals. We'd love to sit down and have an introductory conversation around that and help see if there's an opportunity where we can help benefit that portfolio review and financial planning progress there. So with that, I'm happy to take any questions There's a react button on the Zoom sort of toolbar that you should see. If you hit that, we'll be able to kind of see it pop up there and call you out. So if you have any questions, feel free to do that right now. And then while we're just waiting for that to queue up, I'm just going to take a quick look at my calendar and let you know about the next upcoming session that we have happening on Friday, September the 18th. We're going to talk a little bit about debt management. So certainly, if you have some time, mark that down on the calendar. And again, we hope that you'll be able to join us here for that next edition of Financial Fridays. Again, Friday, September the 18th. So at this point, it doesn't look like we've got any questions queuing up here. And again, if you're not comfortable asking in this setting, certainly, please give us a call and reach out to us, and we're happy to kind of answer some of those questions that you may have offline, etc. So with that, as there's no questions queuing up here, I want to take a moment and thank you again for taking some time out of your day. We know it's a Friday here in August, and it's in the Northeast. It looks like a pretty nice day out there, so we can't thank you enough for taking the half hour or so. Hopefully you found some of the information valuable and maybe learned a thing or two here. But again, we're happy to help in any way we can here moving forward, and we hope to see you on the next edition of the Financial Fridays on September the 18th. So thanks again. I hope everybody has a terrific weekend.